Imagine being able to invest in the future of space travel, artificial intelligence, and some of the most powerful private tech companies in the world, all in a single fund. Companies like SpaceX, OpenAI, Stripe, Databricks, Canva, Figma, and more. For many retail investors, that sounds like a once-in-a-lifetime opportunity. But what if I told you that this same opportunity might actually come with hidden risks most people are not paying attention to? Today, we're breaking down Powerlaw Corp, ticker PWRL, and why some analysts believe it could be one of the most dangerous retail access private tech funds in the market right now. Part 1. What is PWRL? PWRL is a publicly traded fund that gives investors exposure to private companies. Normally, these companies are not accessible to retail investors. You can't just go on a brokerage app and buy shares of SpaceX or OpenAI. So what PWRL does is simple. It pools capital from investors and invests directly into these private companies, giving you indirect exposure. On paper, it sounds powerful. You're basically betting on the next generation of tech giants before they even go public. But the structure of this fund creates some important risks that most people ignore. Part 2. The concentration problem. One of the biggest issues with PWRL is concentration. This is not a broadly diversified fund. It is heavily weighted toward a few names. And the biggest one is SpaceX. Around 19% of the entire fund is tied to SpaceX alone. Then you have other major holdings like OpenAI, Stripe, and several fast-growing private companies. In fact, the top 5 to 6 holdings make up nearly half of the entire portfolio. Now think about that for a second. If 1 or 2 companies in that group perform poorly, or if their valuations get adjusted, the entire fund can move sharply. This is not the type of diversification most investors assume they are getting. This is concentrated private tech exposure wrapped inside a single ticker. Part 3. The NAV premium issue. Now let's talk about something many retail investors don't fully understand. Net asset value, or NAV. NAV is basically the estimated value of all the underlying assets in the fund. According to reported numbers, PWRL's NAV per share is around $13.97. But here's the interesting part. The fund has been trading in the market at roughly a 22% premium to its NAV. In simple terms, investors are paying more than what the actual underlying assets are worth. Why would that happen? It usually comes down to hype, demand, and access. People are willing to pay extra just to get exposure to companies like SpaceX and OpenAI. But premiums like this create risk. Because if sentiment changes, that premium can disappear very quickly. And when that happens, investors don't just lose future gains, they can lose capital. Part 4. The SpaceX effect. Now we need to talk about the biggest driver of this entire story, SpaceX. SpaceX is not just another holding in this fund. It is the core narrative. Reports suggest that SpaceX is targeting a potential IPO valuation around $1.7 trillion. That alone makes it one of the most anticipated public listings in history. But valuation experts are not all aligned. For example, Aswath Damodaran has estimated SpaceX's fair value closer to $1.3 trillion, based on a detailed breakdown of its business segments like rockets, Starlink, and future AI initiatives. Now here's the key idea. If the IPO happens closer to the higher number, sentiment stays strong. But if the market eventually reassesses the valuation closer to the lower range, there could be meaningful downside pressure. Some estimates suggest that could mean a 20 to 25% adjustment in valuation after listing. And that matters a lot for PWRL, because nearly 1/5 of the entire fund is tied to this single company. Part 5. IPO behavior and market psychology. History also gives us context here. When major private companies go public, there is usually a pattern. First comes excitement. Retail investors rush in. Early trading pushes prices higher due to hype and limited supply. But then something changes. Early investors and insiders begin to take profits. The initial excitement fades, and reality starts to matter more than narrative. We've seen this pattern in many large IPOs over the years. Not always, but often enough that it matters. And if SpaceX follows even a similar pattern, the ripple effect will be felt across funds heavily exposed to it. Part 6. The hidden structural risk. Now let's bring everything together. PWRL is not just a SpaceX story. It also includes other high-profile companies like OpenAI, Stripe, and several emerging tech names. But the structure has three major risks. First, concentration risk. Too much exposure to a few companies. Second, valuation risk. The fund is trading above its NAV, meaning investors are already paying a premium. Third, liquidity and sentiment risk. These are private companies. Their valuations are not constantly updated by open markets, which means pricing can lag until it suddenly adjusts. This creates a situation where sentiment can stay elevated for a long time. But corrections, when they come, can be sharp. Part 7. The bull case. Now, to be fair, there is another side to this story. If SpaceX continues to outperform expectations, if Starlink scales globally, if AI integrations across these companies unlock new revenue streams, then valuations could expand further. Some optimistic scenarios suggest SpaceX could push beyond current projections and justify even higher long-term valuation ranges. In that case, funds like PWRL could benefit significantly. So this is not a one-sided story. It is a high upside, high risk structure. Part 8. Final thoughts. So what's the bottom line? PWRL represents a new type of retail investment product. It gives access to private tech giants before IPOs. But that access comes at a cost. High concentration, premium pricing, and heavy dependence on a single narrative, SpaceX. This is not a traditional diversified fund. It is a concentrated bet on a handful of companies shaping the next decade of technology. And like all concentrated bets, the outcome can swing dramatically in either direction. So the real question is not whether this fund is interesting. It absolutely is. The real question is whether the risk you are taking matches the price you are paying for that access. Because in markets like this, sometimes the biggest risk is not what you own. It's how much you're paying to own it.